What if I told you that one of the biggest wealth-creating opportunities in India isn't being built inside flashy technology companies, but inside warehouse, factories, food processing plants, pharmaceutical laboratories, and logistics parks? And what if the company we're discussing today isn't selling a product that most people even notice, yet quietly touches millions of lives every single day? Think about India 20 years ago. The country's biggest economic conversations revolved around services, software, banking, telecommunications, consumption. Manufacturing certainly existed, but it rarely occupied center stage. Today, something remarkably different is unfolding. Without making dramatic headlines every week, policymakers have been steadily changing the country's economic foundation. Roads are becoming wider. Dedicated freight corridors are expanding. Ports are handling greater volumes. Industrial clusters are growing. Cold storage infrastructure is receiving greater attention. Agricultural supply chains are becoming more organized. Export competitiveness is improving. Domestic manufacturing is being encouraged. The objective isn't merely to produce more goods. The objective is to build an ecosystem where businesses can manufacture efficiently, transport faster, waste less, consume less energy, and compete globally. At first glance, these developments may appear completely unrelated. A highway in one state, a logistics park in another, a food processing cluster somewhere else, a pharmaceutical manufacturing facility, an export terminal. They seem like separate stories. But if you zoom out, they begin looking like pieces of one enormous puzzle. And that puzzle has one simple objective: reduce friction. Because every economy grows when friction reduces. Imagine running a marathon while carrying a heavy backpack. Now imagine someone gradually removes weight from that backpack. The runner hasn't become stronger overnight. The road hasn't become shorter. But progress becomes faster because resistance has reduced. Economies work in exactly the same way. When transportation improves, products move faster. When logistics improve, inventory costs fall. When cold storage expands, food wastage declines. When manufacturing ecosystems strengthen, businesses become more competitive. When businesses become more competitive, they invest more. And when investments increase, an entirely new chain reaction begins. Most investors stop here. They immediately start searching for the biggest automobile manufacturer, the largest food company, the fastest growing retailer, the most famous export business. But history teaches us something fascinating. The biggest winners are often not the companies standing in the spotlight. They're the businesses quietly supplying the spotlight. Let me explain. Imagine India decides to build 100 new hospitals. Most people immediately think about hospital operators. But who benefits before the hospital even opens? Companies making medical refrigeration, industrial cooling systems, construction equipment, power backup solutions, medical gas infrastructure. Every hospital needs these businesses before it can treat its first patient. The same principle applies across industries. When food processing expands, cold chain infrastructure expands. When pharmaceutical manufacturing expands, temperature-controlled logistics become essential. When organized retail grows, cold storage becomes indispensable. When exports increase, product preservation becomes even more critical. Notice something interesting. Different industries, different customers, different products, yet one common requirement quietly connects all of them. Cooling. Not the kind we notice every day inside our homes. The invisible cooling systems that preserve medicines, protect food, maintain industrial processes, and keep modern supply chains functioning. Without them, the entire system becomes inefficient. This is one of those industries people rarely think about, until they realize how impossible modern life would be without it. There's an investing concept called second-order thinking. It sounds complicated, but the idea is beautifully simple. First-order thinking asks, which company sells the most products? Second-order thinking asks, Who benefits regardless of which company wins? Imagine the smartphone industry. Some investors tried predicting which handset manufacturer would dominate. Others invested in businesses supplying chips, sensors, manufacturing equipment, and specialized materials. Sometimes, selling tools to every competitor becomes a more durable business than betting on a single champion. The same thinking applies here. Instead of asking, which food company will grow? Ask, who helps preserve the food? Instead of asking, which pharmaceutical company will expand? Ask, who protects the temperature-sensitive medicines? Instead of asking, which retailer will open more stores? Ask, who builds the refrigeration systems those stores cannot operate without? That subtle shift changes the way investors look at businesses. And it introduces another powerful mental model, the picks and shovels model. During the great gold rushes, thousands of people searched for gold. Some became wealthy. Most didn't. But almost everyone needed picks, shovels, boots, and equipment. The companies supplying those tools often built steadier businesses than many of the miners themselves. Why? Because they weren't dependent on one winner. They benefited from the entire ecosystem expanding. That's exactly the lens through which today's company should be viewed. Not simply as a refrigeration manufacturer, not merely as an engineering business, but as an infrastructure enabler. A company positioned at the intersection of agriculture, food processing, industrial manufacturing, pharmaceutical logistics, cold chain development, and India's steadily evolving manufacturing landscape. Now here's where the story becomes even more interesting. Many businesses participate in a growing industry. Very few become indispensable to that industry's growth. That difference determines whether a company merely grows with the economy or compounds shareholder wealth for decades. So before we study financial statements, before we analyze valuation, before we examine charts, or discuss management, we must answer one fundamental question. Is this company simply riding a favorable industry wave? Or is it quietly becoming one of the businesses helping create that wave? Because if the answer is the second, then we are no longer analyzing just another listed company. We are beginning to understand a business whose future may be tied not only to its own execution, but to the transformation of India's industrial economy itself. And that is where the real story begins. The business you never notice, until you realize the modern economy cannot function without it. Now let me ask you something. Have you ever gone to a supermarket and wondered why the fruits still look fresh after traveling hundreds of kilometers? Or how vaccines safely reach hospitals during the peak of summer? Or why a restaurant can serve frozen food that tastes almost as fresh as the day it was produced? Or how quick commerce companies promise to deliver ice cream in the middle of a scorching afternoon without it melting? Most of us never ask these questions, because when a system works perfectly, it becomes invisible. Electricity is invisible until there's a power cut. The internet is invisible until it stops working. The braking system of your car is invisible until you need it in an emergency. Industrial refrigeration belongs to the same category. People rarely appreciate it, because when it performs well, nothing goes wrong. Food doesn't spoil. Medicines remain effective. Factories continue operating. Supply chains keep moving. The absence of a problem often hides the importance of the solution. And that is exactly where today's company enters the story. ICE Make Refrigeration isn't in the business of selling refrigerators. It isn't trying to compete with the appliance sitting inside your kitchen. Its world is far more complex. Imagine the journey of a packet of frozen vegetables. It begins on a farm, moves to a processing facility, travels to a cold storage warehouse, then to a distribution center, finally to a supermarket, or directly to your doorstep. Now imagine that somewhere during this journey, the temperature rises for just a few hours. The vegetables may still look perfectly fine, but their quality may already be compromised. The same principle becomes even more critical in pharmaceuticals. Many medicines don't simply need transportation. They need controlled transportation. They need controlled storage. They need controlled manufacturing environments. Because a small temperature variation doesn't merely reduce quality. It can reduce effectiveness. In industries like food, healthcare, dairy, seafood, chemicals, and specialized manufacturing, temperature isn't just another operating parameter. Temperature becomes part of the product itself. That is why companies like ICE Make don't merely manufacture equipment. They manufacture confidence. Confidence that a customer will receive the same quality that left the factory. And confidence is an extremely valuable business. Think about the aviation industry. Passengers don't buy airline tickets merely because they want transportation. They buy confidence that they'll reach safely. Banks don't simply store money. They store trust. Insurance companies don't sell policies. They sell peace of mind. Similarly, industrial refrigeration companies don't merely sell cooling equipment. They sell reliability. The ability to protect products worth hundreds of crores every single day. This changes the way we should think about the business. Because businesses that protect value often become more important than businesses that merely create value. Imagine a warehouse storing pharmaceutical products worth 500 crore rupees. The refrigeration system protecting those medicines might cost only a tiny fraction of that amount. But if the cooling system fails, the financial loss could be enormous. Now ask yourself, when choosing such a system, will the customer simply buy the cheapest option? Probably not. Because when the cost of failure is significantly higher than the cost of quality, customers begin choosing reliability over price. This introduces one of the most powerful concepts in investing: mission-critical products. A mission-critical product is something customers cannot afford to fail. It may represent only a small percentage of the total project cost, but it protects the entire project. Imagine constructing a 30-story building. The foundation may account for only a part of the overall cost. But nobody asks the contractor to save money by weakening the foundation, because the entire building depends upon it. Mission-critical products create something investors love. They reduce price sensitivity. And whenever customers become less sensitive to price, companies gain something called pricing power. Pricing power simply means the ability to increase prices without losing valuable customers. Think about your favorite doctor. If consultation fees increase slightly, many patients still continue visiting. Not because the doctor is cheap, but because trust has greater value than the additional fee. Businesses with pricing power often produce better returns over long periods because they compete through expertise rather than discounts. Now let's look at ICE Make's business from another angle. Many investors think engineering companies grow only by selling more products. But that's only one way. The more durable way is by becoming increasingly valuable to existing customers. Imagine a restaurant owner who initially buys one refrigeration system. A few years later, he opens 10 outlets, then a central kitchen, then a cold warehouse, then a food processing unit. If the supplier has consistently delivered quality, who is likely to receive the next order? Usually the company that has already earned trust. This is called customer lifetime value. The first order creates revenue. The relationship creates wealth. Industrial businesses often compound not because they constantly find new customers, but because existing customers continue expanding alongside them. Now consider another fascinating aspect of this industry. Unlike consumer businesses, industrial engineering companies rarely succeed through advertising. They succeed through execution. Different means. No purchasing manager awards a contract because of a television commercial. Contracts are won through technical capability, engineering expertise, after-sales service, timely execution, and years of credibility. That creates a very different type of competitive advantage. In investing, we call this a moat. A moat is simply something that makes it difficult for competitors to take away customers. Imagine two castles. One is surrounded by a deep river. The other has no protection. Which one is harder to attack? The river is the moat. Businesses build similar protection through different means. Some build brands. Some build technology. Some build distribution. Some build customer relationships. Some build execution capability. For ICE Make, the moat isn't likely to come from flashy consumer branding. It comes from engineering expertise, execution, service capability, and long-term customer confidence. But every moat must continuously become deeper. Standing still is not enough. Because industries evolve, technology changes, customer expectations rise, competition improves. Management seems to understand this reality. Instead of remaining only a refrigeration equipment manufacturer, the company has gradually expanded into complete cooling solutions. That distinction is important. Selling equipment creates one transaction. Providing integrated solutions creates an ecosystem. Imagine building a house. You could hire separate contractors for plumbing, electrical work, flooring, painting, and interiors. Or you could appoint one company to manage everything. Which option usually reduces complexity? Exactly. Customers increasingly value integrated solutions because they reduce coordination risk. The more comprehensive the solution, the stronger the customer relationship often becomes. And stronger relationships usually create more predictable business. This naturally brings us to another concept institutions quietly monitor: total addressable market, or TAM. The term sounds complicated, but think of it this way. Imagine opening a bakery in one neighborhood. Your opportunity is limited to that locality. Now imagine supplying flour to every bakery in the city. Suddenly, your market becomes much larger. TAM simply asks one question: how large can this business realistically become if everything goes right? For ICE Make, the opportunity isn't limited to selling refrigeration equipment. Its potential market expands with food processing, cold chain logistics, modern retail, quick commerce, pharmaceutical manufacturing, industrial refrigeration, exports, warehousing, hospitality, and specialized manufacturing. Every one of these industries is becoming more organized. Every one requires reliable cooling infrastructure. That means the runway may still be much longer than many investors initially assume. But here's where mature investors become cautious. A large market alone doesn't guarantee success. India's aviation market is enormous. Not every airline became profitable. The electric vehicle market is expanding rapidly. Not every EV company will create shareholder wealth. A large TAM creates opportunity. Execution converts opportunity into earnings. And earnings convert opportunity into shareholder value. That distinction is extremely important. This is where the story becomes even more interesting. ICE Make has demonstrated that it can grow rapidly. The market has noticed that growth. The chart suggests investors are beginning to pay greater attention. But there is another question quietly waiting in the background. Growth alone doesn't determine long-term wealth. Can the company grow profitably? Can every new factory, every new customer, every additional project, and every rupee invested generate higher returns than before? Because history teaches us something remarkable. Many businesses become larger. Only a handful become significantly more valuable. And the difference between the two isn't revenue. It is capital allocation. It is cash generation. It is return on capital. And perhaps most importantly, it is the quality of management decisions. Which brings us naturally to the next chapter. Because before we judge the numbers, we must first understand the people making those decisions. After all, factories don't create wealth. Machines don't create wealth. Even industries don't create wealth on their own. People allocate capital. And over long periods, capital allocation determines whether a growing company becomes just another industrial business or one of the next generation of wealth-creating compounders. The people behind the business. Can management convert growth into wealth? Every successful business eventually reaches a moment where products stop being the biggest differentiator. Leadership becomes the differentiator. Let me explain. Imagine two farmers. Both own the same amount of land. Both receive the same rainfall. Both grow the same crop. Yet after 10 years, one farmer owns several farms, while the other is still struggling with debt. What changed? Not the land, not the weather, not even the crop. The difference was the decisions made every single season. Businesses are no different. Factories don't decide where to invest. Machines don't decide whether to borrow money. Products don't decide whether to expand into new markets. People do. And that is why experienced investors spend far more time studying management than they spend studying machinery. Because products can be copied. Factories can be built. Technology eventually becomes available to everyone. But disciplined leadership, that is much harder to replicate. Now think about ICE Make. At first glance, the story looks impressive. Revenue has expanded rapidly. The company has entered new customer segments. Manufacturing capacity has increased. The market has gradually started paying attention. Naturally, most investors conclude, management must be doing an excellent job. Maybe. But institutional investors don't stop there. They ask a much more difficult question. Is management creating growth or creating wealth? Those two things sound identical. They are not. Imagine a shopkeeper. His sales increase from 1 crore to 5 crores in 5 years. That sounds wonderful. But what if, to achieve that growth, he had to borrow heavily, accept very low profit margins, and earn less on every additional rupee invested? Has the business become bigger? Absolutely. Has it become better? Not necessarily. That is why professional investors don't celebrate revenue alone. They celebrate quality of growth. And quality of growth is largely determined by one skill: capital allocation. Capital allocation sounds like a complicated financial term. It really isn't. Imagine you receive a yearly bonus of 10 lakh rupees. You now have several choices. You could spend it on luxury holidays. You could buy another house. You could invest in your children's education. You could start a new business. You could repay debt. Each decision creates a different future. Companies face exactly the same choices. Every rupee they earn must be allocated somewhere. Build another factory, acquire another company, develop new technology, reduce debt, pay dividends, increase research spending. None of these decisions are automatically right or wrong. Their success depends on one simple question. Will today's investment create much larger value tomorrow? This is why Warren Buffett often says that management's greatest responsibility is not merely running operations. It is allocating capital intelligently. Now let's connect that idea to ICE Make. Over the last few years, management has invested aggressively. Factories have expanded. Assets have increased. Borrowings have also increased. On the surface, this looks like confidence. And sometimes it genuinely is. Imagine a restaurant owner. Business is booming. Customers are waiting outside every evening. He decides to open a second branch. Would anyone criticize him for investing? Probably not, because demand already exists. Expansion becomes logical. But now imagine another restaurant owner. His existing restaurant remains half empty. Yet he opens 3 additional branches. The decision suddenly looks very different. Expansion itself isn't impressive. Profitable expansion is. This is exactly where ICE Make story becomes fascinating. Management clearly believes the opportunity ahead is significantly larger than the business today. Their investments tell us that. Businesses communicate in 2 languages. The first is words. The second is money. Words appear in interviews. Money appears in balance sheets. And money is usually the more honest language. Every new factory, every additional manufacturing line, every increase in capacity, is management quietly saying, we believe tomorrow will justify today's investment. Now comes the difficult part. Belief is not enough. Execution must eventually validate that belief. This introduces another mental model, the bridge model. Imagine standing beside a river. You decide to build a bridge. Initially, your expenses increase dramatically. Steel, concrete, labor, engineering. Your bank balance falls. People begin questioning your decision. But once the bridge is complete, traffic begins flowing, businesses expand, trade increases, property values rise. Suddenly, what looked expensive becomes incredibly valuable. Growth investments often behave exactly like bridges. Initially, they reduce profitability, increase depreciation, increase debt, reduce free cash flow. Later, if management was correct, those same investments begin generating higher earnings for many years. The challenge for investors is simple. Can management successfully cross the bridge? That is where ICE Make stands today. The bridge has been built. Now the market is waiting to see how much traffic eventually crosses it. And this naturally leads us to another important idea. Return on incremental capital. The name sounds intimidating. Let's simplify it. Imagine you own a grocery store. You invest another 1 crore rupees to expand. Next year, your profits increase by only 2 lakh rupees. Clearly, that investment wasn't particularly attractive. Now imagine another grocery owner. He invests the same amount. His profits increase by 25 lakh rupees. Which business deserves a higher valuation? Obviously, the second one. The market doesn't reward companies simply because they invest. It rewards companies because their investments create exceptional returns. This is why ICE Make's future will depend less on how much it spends, and more on how effectively those investments begin producing profits. Now let's talk about another aspect institutions quietly monitor: management guidance. Most retail investors misunderstand guidance. They think guidance is management predicting the future. Experienced investors think differently. Guidance reveals priorities, not certainty. When management consistently invests in manufacturing, capacity, technology, distribution, and execution, they're telling us where they believe the industry is heading. Notice something interesting. Management hasn't built the company around a single customer or a single industry. Instead, its solutions serve food processing, cold chain logistics, pharmaceuticals, industrial refrigeration, hospitality, retail, and multiple industrial applications. This diversification reduces dependence on any one demand cycle. Imagine owning a farmer who grows only one crop. Now compare him with another farmer growing vegetables, fruits, and grains. If one crop has a bad season, the second farmer still survives. Diversification doesn't eliminate risk, but it reduces dependence on one outcome. That creates resilience. And resilience is one of the defining characteristics of long-term compounders. Now let me introduce another concept that separates institutional investors from everyone else: skin in the game. People behave differently when their own money is involved. Imagine hiring two architects. One is paid a fixed salary regardless of the building's quality. The other will live in the building with his own family. Who is likely to care more about the foundation? Exactly. When promoters retain significant ownership, their interests are generally more aligned with shareholders because they participate in both the upside and the downside. At the same time, investors should continue monitoring any pledged shares and changes in ownership, since these can affect financial flexibility and governance over time. Now let's connect everything. Management believes the opportunity is large. Industry demand appears favorable. Capacity has increased. Customers are expanding. The market has begun recognizing the story. Everything appears encouraging. Yet, there's one uncomfortable truth. None of these things automatically create shareholder wealth. History is full of companies that expanded rapidly, built factories, borrowed aggressively, entered exciting industries, and still failed to create lasting returns. Why? Because they confused growth with value creation. Value creation follows a different chain. Better products lead to stronger customer trust. Stronger customer trust creates pricing power. Pricing power supports healthier margins. Healthier margins generate stronger operating cash flow. Cash flow funds future expansion without excessive dependence on debt. That expansion creates higher returns on capital. And only then does long-term shareholder wealth begin compounding. This is the chain institutional investors quietly observe. Not one quarter, not one annual report, year after year. And this brings us to perhaps the most revealing chapter of the entire documentary. Because management may have the right vision. The industry may have enormous potential. The products may solve real-world problems. But there is only one place where every decision ultimately becomes visible. The financial statements. Not because numbers tell the whole story, but because they reveal whether the story management is telling is gradually becoming reality. And sometimes, the most important story hidden inside a balance sheet isn't how much a company earned. It's how efficiently it earned it. That is exactly where our journey goes next. The numbers tell a different story. And that's where the real investigation begins. Up until now, our story has sounded almost perfect. A company operating in a growing industry. A management team investing aggressively. Strong revenue growth. A business benefiting from long-term structural changes. And a market that has gradually started paying attention. If we stopped the documentary here, most viewers would probably conclude, this sounds like a fantastic investment. But investing becomes dangerous precisely at this moment. Because this is where many people fall in love with a story. Before checking whether the numbers support it. There's an old saying in business. Revenue is vanity. Profit is sanity. Cash is reality. At first, it sounds like a catchy quote. But hidden inside it is one of the biggest lessons in investing. Imagine you own a restaurant. Every month, the restaurant becomes busier. More customers arrive. Sales keep increasing. Friends congratulate you. Yet at the end of every month, you still don't have enough cash to pay suppliers without borrowing from the bank. Has your business grown? Yes. Has your financial strength improved? Not necessarily. Growth alone never creates wealth. Profitable growth does. Cash-generating growth does. Let's see what ICE Make's financial journey is trying to tell us. The first thing that catches our attention is impossible to ignore. Revenue has grown at a remarkable pace. Year after year, the company has continued expanding its top line. That tells us demand exists. Customers are buying. Projects are being executed. The company is winning business. In fact, if revenue alone decided investment success, our investigation would already be over. But revenue is only the first chapter of a financial story. The second chapter asks a much tougher question. How much of every additional rupee of sales actually stays with the business? Imagine two shopkeepers. Both increase annual sales by 1 crore rupees. The first earns 15 lakh rupees from that additional business. The second earns only 2 lakh rupees. Who created more value? Clearly the first. This difference is called operating margin, often referred to as OPM. Let's simplify that. Imagine you sell mango juice. You charge 100 rupees for every bottle. After paying for mangoes, labor, electricity, packaging, transportation, and factory expenses, whatever remains before interest and taxes becomes your operating profit. Operating margin simply tells us how much of every 100 rupees survives after running the business. Higher margins usually indicate one of three things: better efficiency, better pricing power, or stronger competitive advantage. Now here's where ICE Make story becomes interesting. Despite strong revenue growth, operating margins have gradually become thinner. Think of a marathon runner. He's running faster than before, but he's becoming increasingly tired. The speed is impressive. The efficiency is not improving at the same pace. That doesn't automatically mean something is wrong. Sometimes businesses intentionally sacrifice margins while expanding capacity, entering new markets, or building long-term customer relationships. The important question is whether those sacrifices eventually create stronger profitability. Remember the bridge we discussed in the previous chapter? This could simply be the cost of building that bridge. Oh, it could be a warning that the bridge is becoming more expensive than expected. The numbers alone cannot answer that. Only future execution can. Now let's move to another concept that many investors overlook. Net profit margin. Operating margin tells us how efficiently the business runs. Net profit tells us what finally belongs to shareholders after paying interest, taxes, and every other expense. Think of a family. Salary comes into the house every month. Then come school fees, electricity bills, home loan, insurance, medical expenses. Only after paying everything does the family discover how much money is actually left. Businesses work exactly the same way. Revenue enters first. Shareholder profit comes last. And here too, ICE Makes profits haven't grown with the same strength as its revenues. That doesn't destroy the investment case, but it changes the conversation. The story is no longer, can the company grow? Instead it becomes, can the company convert growth into profitable growth? That is a much more important question. Now let's discuss perhaps the single most important ratio for long-term investors. Return on capital employed, or ROCE. Forget the formula. Imagine two farmers. Each receives 100 acres of fertile land. The first produces crops worth 25 lakh rupees every year. The second produces only 10 lakh. Who is the better farmer? Obviously the first. ROCE asks exactly the same question. How efficiently does management use every rupee invested in the business? ICE Make demonstrated excellent capital efficiency. The business was generating attractive returns. But recently, those returns have declined meaningfully. Now before jumping to conclusions, let's understand why this can happen. Imagine opening a new hotel. Construction finishes today. Guests don't arrive tomorrow. It takes time. Marketing begins. Bookings increase. Occupancy gradually rises. Initially, returns appear weak because the investment has already been made while revenue is still catching up. Factories often behave similarly. Large investments reduce returns temporarily until utilization improves. That could be exactly what we're seeing here. Oh, it could indicate that future projects are generating lower returns than previous ones. Both possibilities exist, and that is why ROCE deserves continuous monitoring rather than one-time judgment. Professional investors don't panic because ROCE falls for 1 year. They panic if it never recovers. Now let's move to something even more powerful than accounting profit. Cash flow. Earlier I said, cash is reality. Here's why. Imagine your neighbor proudly tells you, I've become very wealthy. You congratulate him. A week later, he asks to borrow money for paying electricity bills. Something doesn't add up. Businesses sometimes behave the same way. Accounting profits can increase, yet operating cash remains weak. Why? Because customers haven't paid. Inventory has increased. Working capital has expanded. Or growth is consuming cash faster than it is being generated. ICE Make's recent financial statements tell us exactly this story. Cash generation has come under pressure despite business expansion. Does that automatically mean the company is weak? No, because context matters. Imagine building a shopping mall. During construction, cash flows will almost certainly be negative. That doesn't make the mall a poor investment. The real question is, what happens after construction ends? Will the mall attract tenants? Will rental income justify the investment? Will occupancy improve? Similarly, ICE Makes cash flow today should be judged together with tomorrow's return on those investments. This naturally introduces another concept, free cash flow. Think of your monthly salary. After paying every household expense, and after setting aside money to maintain your house, whatever remains is truly yours to invest. That is free cash flow. It is the money a company can use to reduce debt, pay dividends, acquire another business, or invest in future growth without depending excessively on banks. Recent free cash flow has remained under pressure. Again, this is understandable during a heavy expansion cycle, but investors should expect this to improve over time. Otherwise, growth gradually becomes dependent on external financing, which brings us to another part of the balance sheet: debt. Debt is probably the most misunderstood word in investing. Many people think debt is automatically dangerous. That's not true. Imagine two entrepreneurs. The first borrows 1 crore rupees to build a highly profitable factory that earns 30 lakh rupees every year. The second borrows the same amount to build a factory that barely survives. Who made the better decision? Debt wasn't the problem. The quality of the investment was. This is why institutions never ask, how much debt does the company have? They ask, can the company comfortably earn more from borrowed money than it pays in interest? ICE Make's borrowings have increased significantly over recent years. That isn't necessarily negative, but it raises the standard of execution. Every additional rupee borrowed now carries responsibility. Management must ensure those investments begin generating attractive returns. Otherwise, interest costs gradually reduce shareholder wealth. Now let me connect everything we've discussed. Revenue is growing. The industry opportunity remains attractive. Management is investing. Capacity is expanding. Yet, margins have softened. Cash generation has weakened. Debt has increased. ROAS has declined. Notice something fascinating. None of these facts contradict each other. In fact, they tell one coherent story. The company appears to be moving through an investment phase rather than a harvesting phase. Think of planting an orchard. For the first few years, expenses dominate. Trees consume water, fertilizer, labor, maintenance. There is little fruit. Then one season, the orchard begins producing. The same assets suddenly start generating cash. The challenge for investors is determining one thing. Is ICE Make planting an orchard, or merely watering a field that may never produce enough fruit? That single question will decide whether today's investments become tomorrow's wealth. And this is exactly where valuation enters the picture. Because valuation is nothing more than the market's opinion about how that question will eventually be answered. Some investors believe the orchard will flourish. Others believe expectations have already become too optimistic. Who's right? That is where our investigation becomes even more interesting. Because the next chapter isn't about the past. It's about the future the market has already begun pricing into the stock. And that future may already be worth far more than today's financial statements suggest. The price of a great business. When does quality become too expensive? Imagine you're standing in front of two houses. The first house is beautiful, excellent location, strong construction, wonderful neighborhood. You immediately fall in love with it. The second house is ordinary, nothing special, needs repairs. Now let me ask you a simple question. Which one should you buy? Most people instinctively point to the first house. But experienced investors ask a different question. At what price? Because even the most beautiful house can become a poor investment if you overpay for it. And sometimes, an average house purchased at the right price can generate surprisingly good returns. This brings us to one of the biggest misconceptions in investing. People often confuse a great company with a great investment. They're not always the same thing. A company may have brilliant management, an expanding industry, strong products, and an exciting future. Yet, if the market has already priced in years of perfection, future returns may disappoint. On the other hand, a company with improving fundamentals but modest expectations can sometimes create extraordinary shareholder wealth. The difference lies in one word: expectations. The stock market is not a scoreboard of today's business. It is a marketplace of tomorrow's expectations. Imagine two students appearing for an examination. One is expected to score 98 marks. The other is expected to score 60. The first student scores 95. The second scores 80. Who receives more appreciation? Usually the second. Not because 80 is greater than 95, but because expectations were different. Stocks behave exactly the same way. If expectations are already sky high, even excellent performance may fail to excite investors. If expectations are modest, steady improvement can lead to powerful re-rating. This is why institutional investors spend enormous time understanding what the market already believes, not just what the company is doing. Now let's look at ICE Make through that lens. Over the last few years, the company has transformed from being relatively unknown to gradually attracting institutional attention. Revenue has grown rapidly. The opportunity in industrial refrigeration looks promising. Management has expanded capacity. The business appears to be entering conversations where improving industrial companies often begin attracting long-term investors. Naturally, the market has rewarded this progress. And here's where things become interesting. The market is no longer valuing ICE Make solely on its current earnings. It is valuing the possibility of much stronger earnings in the future. That distinction changes everything, because investors are no longer buying yesterday. They are buying tomorrow. Let's understand this using a simple analogy. Imagine a mango tree. Today, it produces 100 kilograms of mangoes every season. But everyone believes that 5 years from now, it will produce 500 kilograms. If you decide to buy that tree today, are you paying only for today's harvest? Of course not. You're paying for the harvest you expect over many years. Stocks work in exactly the same way. The market pays for future cash flows, not merely current profits. This brings us to the first valuation framework: price-to-earnings ratio, paying for tomorrow's profits. Most investors have heard of the price-to-earnings ratio, or PE, but many misunderstand what it really means. Forget formulas for a moment. Imagine two identical rental apartments. Each generates an annual rent of 1 lakh rupees. One apartment is available for 10 lakh rupees. The other costs 30 lakh. Why would anyone pay 3 times more for essentially the same rental income? Probably because they believe the expensive apartment sits in a rapidly developing area where rents and property values will grow much faster. The additional price represents expectation. Similarly, a high PE doesn't automatically mean a stock is expensive. It often means the market expects stronger future growth. The danger arises when those expectations become unrealistic. If growth slows, the premium can disappear surprisingly quickly. And that is why a company can report excellent quarterly numbers, yet its share price still declines. The business improved, but not enough to justify the market's expectations. Growth alone is not enough. Now let me introduce another concept institutions quietly monitor: the PEG ratio. It sounds technical. In reality, it's beautifully logical. Imagine two children. One grows 5 centimeters every year. The other grows 15 centimeters every year. Would you value their future potential equally? Probably not. Growth matters. Similarly, if two companies trade at the same valuation, but one is growing much faster, the faster growing business may actually represent better value. The PEG ratio simply asks, is the valuation reasonable compared with the expected growth? Notice the wording. Reasonable, not cheap. Institutional investors rarely chase the cheapest companies. They search for businesses where quality and growth justify the price being paid. This is one reason why many legendary compounders have often looked expensive throughout their journeys. The market wasn't paying for the present. It was paying for a future that continued unfolding. Discounted cash flow, the business as a money machine. Now let's discuss one of the most respected valuation methods in finance: the discounted cash flow, or DCF. The name sounds intimidating, but the idea is surprisingly intuitive. Imagine someone offers to give you 1 lakh rupees. You have two choices. Receive it today, or receive it 10 years from now. Which would you choose? Almost everyone chooses today. Because money available today can be invested, earn returns, and provides certainty. A rupee today is therefore worth more than a rupee received in the distant future. DCF applies this same logic to businesses. Instead of asking, how much did the company earn this year? It asks, how much cash is this business likely to generate over many years? And what is that stream of cash worth in today's terms? For a business like ICE Make, this becomes especially relevant because today's investments are intended to generate tomorrow's cash flows. If management executes well, future cash generation could justify today's valuation. If execution disappoints, today's optimism may prove excessive. DCF, therefore, isn't about predicting the future perfectly. It's about recognizing that small changes in future assumptions can dramatically change today's valuation. Why markets reward quality? Here's something fascinating. Suppose two companies earn exactly the same profit today. One has consistent cash flows, strong management, healthy balance sheet, disciplined capital allocation. The other has unpredictable earnings, weak cash conversion, high leverage, frequent strategic changes. Would investors value them equally? Almost certainly not, because investors don't only buy earnings. They buy confidence in the sustainability of those earnings. That confidence itself has value. It is often called the quality premium. High-quality businesses usually receive higher valuations because the market believes they're more likely to continue creating wealth over long periods. But here's the catch. Even quality has a price beyond which future returns become less attractive. Imagine paying 10 crore rupees for a shop that can realistically earn only 20 lakh rupees a year. The shop may be wonderful, but the investment may still disappoint. This is why valuation is not about deciding whether a business is good. It is about deciding whether the price already reflects that goodness. Expectation versus reality, the battle that moves share prices. Every quarter, every annual report, every management commentary feeds into one ongoing contest, not between buyers and sellers, but between expectation and reality. If reality exceeds expectations, valuations often expand. If reality merely matches expectations, share prices may barely move. If reality falls short, even a good business can experience sharp corrections. This explains why markets sometimes appear irrational. They're not reacting to absolute performance. They're reacting to the difference between what was expected and what actually happened. For ICE Make, the market appears to be saying, we believe the investments being made today will produce significantly stronger earnings tomorrow. That is a vote of confidence. But confidence must continuously be earned. Each new factory must become productive. Each expansion must improve returns. Each borrowed rupee must create more value than it costs. Only then does a premium valuation remain justified. The margin of safety. Before we end this chapter, there is one final mental model every investor should remember. Margin of safety. Imagine you're driving on a mountain road. Would you prefer the road to have a safety barrier? Of course. You hope you'll never need it, but you're grateful it's there. In investing, valuation is that safety barrier. Buying a wonderful business at a sensible price provides room for mistakes, unexpected delays, or temporary economic slowdowns. Buying the same business at an excessively optimistic price removes that protection. The company may still succeed, but your investment experience may not. That is why professional investors don't ask, is this an excellent company? They ask, what has to happen over the next 5 to 10 years for today's price to be fully justified? That single question separates speculation from disciplined investing. And once we understand valuation, we can finally connect all the pieces of the puzzle. The industry, the management, the financial evolution, the market's expectations. Now there's only one chapter left before we bring everything together. Because none of these elements exist in isolation. A business improves. Financial statements begin to reflect that improvement. Institutions quietly notice. Market psychology changes. The technical structure evolves. Valuation responds. And eventually, what once looked like an ordinary industrial company can begin a completely different journey. But that journey never starts on a stock chart. It starts inside the business itself. And that is exactly where our final chapters take us. When the market begins to notice how fundamentals slowly become price. Have you ever wondered why two investors can look at the same company and arrive at completely different conclusions? One says, it's already too expensive. The other quietly keeps buying. One believes the opportunity has already passed. The other believes the journey has only just begun. Who is right? The surprising answer is, both might be, because they are looking at different points in the same journey. One is looking at today's price. The other is looking at tomorrow's business. And somewhere between those two lies one of the most fascinating concepts in investing. The market rarely discovers a great business overnight. It discovers it gradually. Imagine a new restaurant opens in your city. On the first day, only a handful of people know about it. A few customers visit. Some like the food. They recommend it to friends. More customers arrive. Food bloggers begin talking about it. Online ratings improve. Queues start forming outside. Eventually, people who never heard of the restaurant suddenly assume it has always been famous. But success didn't happen in one evening. Recognition simply arrived later than reality. The stock market behaves in exactly the same way. Businesses improve first. Recognition comes later. Prices adjust only after enough people begin believing the improvement is sustainable. This is why institutional investors spend far more time studying businesses than watching share prices. Because they know something most beginners overlook. Price follows conviction. And conviction follows evidence. The silent chain reaction. Think back to everything we've discussed so far. A company develops better products. Customers become more satisfied. Orders begin increasing. Factories operate more efficiently. Revenue grows. Management gains confidence. Expansion begins. Analysts notice. Institutional investors start asking questions. Research reports become more frequent. Liquidity improves. Long-term investors slowly enter. Eventually, the broader market begins paying attention. Notice something important. At no stage did the stock price itself create the business. The business created the stock price. This is one of the biggest mental shifts an investor can make. Instead of asking, why is the stock going up? Ask, what has improved inside the business that is causing investors to pay more attention? That single question transforms speculation into analysis. Understanding institutional behavior. Many retail investors imagine institutions as giant organizations that suddenly decide to buy millions of shares on a single day. Reality is far more patient. Imagine you're responsible for investing 20,000 crore rupees. Would you rush into a relatively small company and buy everything in one afternoon? Of course not. Doing so would push the price sharply higher. Instead, you would buy gradually, week after week, month after month, as confidence increases, as new information confirms your thesis, as liquidity improves. Institutional investing resembles filling a large reservoir. You don't pour an ocean into it at once. You let it fill steadily. That gradual accumulation often leaves subtle footprints. Not dramatic explosions. Not speculative excitement. But periods where selling pressure quietly reduces. Corrections become shallower. Recoveries become stronger. Confidence begins replacing uncertainty. This is why experienced investors often say, the market whispers before it shouts. The earliest signs of changing perception are usually quiet. Only later do they become obvious to everyone. Why charts reflect human behavior? Many people think technical analysis is about lines, patterns, or indicators. In reality, those are only visual tools. The real subject of technical analysis is human behavior. Imagine an auction. 10 people want to buy the same antique painting. Initially, everyone bids cautiously. As more bidders arrive, competition increases. Each new bid reflects growing confidence that the painting is worth more. Eventually, the final price becomes a reflection of collective belief. The stock market works exactly the same way. Every transaction is simply one person saying, "I'm willing to own this business at this price," and another person saying, "I'm willing to sell it." Charts don't predict the future. They record this ongoing negotiation. That is why experienced investors don't treat charts as magic. They treat them as a visual record of changing expectations. The difference between speculation and accumulation. Now imagine two different situations. In the first, a company's share price doubles within a few weeks because of rumors. Very little changes in the underlying business. Excitement dominates. News spreads rapidly. Everyone wants quick profits. This is speculation. Now imagine another company. Revenue steadily improves. Customers expand. Management executes consistently. Cash flows gradually strengthen. Quarter after quarter. Confidence quietly builds. The share price rises over time because more investors begin believing the business deserves a higher valuation. This is accumulation. Both situations produce rising prices. But only one creates sustainable wealth. The challenge for investors is learning to distinguish between the two. Reflexivity, when success creates more success. There is another fascinating idea introduced by investor George Soros. It is called reflexivity. The word sounds complicated. The idea is simple. Sometimes, rising success creates conditions for even greater success. Imagine a university. As more talented students join, its reputation improves. Because its reputation improves, even better students apply next year. Success attracts more success. Businesses experience similar cycles. As a company performs well, banks become more willing to lend. Customers become more confident. Suppliers extend better credit. Talented employees want to join. Institutional investors become interested. A higher market valuation makes raising future capital easier. One improvement begins supporting another. This creates a positive feedback loop. But remember, the opposite can also happen. Weak execution, falling confidence, declining valuations, and tighter financing conditions can reinforce each other. That is why maintaining execution becomes so important. The psychology of patience. Let's pause for a moment. Imagine planting a bamboo tree. For years, almost nothing appears above the ground. Many people assume nothing is happening. Then, within a relatively short period, the bamboo suddenly grows rapidly. Did the growth begin only at the end? No. The roots were developing long before anyone could see them. Businesses often follow the same pattern. The market notices visible growth. Institutions often notice invisible preparation. New factories, better systems, improved distribution, technology upgrades, management discipline. These developments may not immediately appear in quarterly profits, but they often lay the foundation for future earnings. Patience, therefore, is not about waiting blindly. It is about understanding where a business sits in its development cycle. Connecting this back to ICE Make. When we step back and look at ICE Make, a clear picture begins emerging. The industry enjoys favorable long-term demand drivers. Management has invested in expanding capacity. Revenue has grown impressively. The company has broadened its presence across multiple industrial segments. The market has gradually started recognizing these improvements. Yet, important questions remain. Can margins recover? Can cash generation strengthen? Can return on capital improve as new facilities mature? Can today's investments begin producing tomorrow's operating leverage? These are not weaknesses in the story. They're the next chapters the business must write. And that is exactly what institutions continue monitoring. Not because they doubt the opportunity, but because sustained wealth creation requires evidence, not optimism. The quiet transition. Perhaps the most interesting phase in any company's life is the transition from being ignored to being observed to finally becoming widely owned. That transition rarely happens because of a single quarter. It happens because business quality improves consistently over many years. And somewhere during that journey, market perception changes. Investors who once asked, "Why should anyone own this company?" begin asking, "Can I afford not to own it?" That shift doesn't begin on a trading screen. It begins inside factories, inside boardrooms, inside customer relationships, inside capital allocation decisions. The stock chart merely reflects those changes later. Which brings us to the final chapter of our documentary. Because we've now explored the industry, the business, the management, the financial journey, the valuation, and the market's changing perception, there is only one question left. If this company succeeds over the next decade, what will actually make it significantly larger than it is today? Because understanding the future is not about predicting numbers. It's about identifying the few forces that truly determine whether a business becomes merely bigger or becomes a long-term wealth creator. The next decade, what could turn ICE Make into a wealth-creating compounder? Imagine you're standing in front of two young trees. Both are the same height. Both appear equally healthy. Both receive the same sunlight. The casual observer concludes, they're identical. But an experienced gardener looks beneath the soil. One tree has developed a deep, strong root system. The other has shallow roots. For the next few months, both trees may continue looking identical. But when the first major storm arrives, their futures become very different. Businesses evolve in much the same way. Financial statements tell us what has happened. Stock prices tell us what investors believe. But the future depends on something deeper, the strength of the roots. And in business, those roots are built through management quality, competitive advantages, customer relationships, innovation, capital allocation, and adaptability. The question is no longer whether ICE Make has grown. It clearly has. The real question is much bigger. Can this business continue creating value for the next 10 years? Because long-term wealth is rarely created by companies that simply become larger. It is created by companies that become increasingly indispensable. The difference between growth and compounding. Let's understand one of the most misunderstood ideas in investing. Growth and compounding are not the same thing. Imagine two people. Both earn 10 lakh rupees this year. The first spends every additional rupee he earns. The second reinvests part of his income into learning new skills, expanding his business, and buying productive assets. 10 years later, who is likely to be wealthier? Almost certainly the second. Why? Because every year's progress becomes the foundation for the next. That is compounding. Businesses follow the same principle. A company grows when revenue increases. A company compounds when today's investments make tomorrow's growth easier, faster, and more profitable. This distinction is incredibly important. Many businesses experience periods of rapid growth. Only a small number become long-term compounders. What creates a compounding business? Imagine building a flywheel. At first, pushing it requires tremendous effort. It barely moves. Every rotation feels difficult. But as momentum builds, each push becomes easier. Eventually, the wheel begins helping itself. Jim Collins, in his book Good to Great, described this as the flywheel effect. Successful businesses often work in exactly the same way. Better products attract better customers. Better customers generate stronger cash flows. Stronger cash flows fund better technology. Better technology improves products further. Customer satisfaction increases. Market reputation strengthens. New customers arrive more easily. The cycle reinforces itself. Notice something fascinating. The company no longer depends on one extraordinary event. Instead, many small improvements begin working together. That is how long-term wealth is quietly created. What could become ICE Make's flywheel? Let's connect this idea to ICE Make. Imagine the next decade unfolds favorably. Food processing continues expanding. Cold chain logistics become more sophisticated. Pharmaceutical manufacturing grows. Industrial automation accelerates. Exports increase. Temperature-controlled infrastructure becomes increasingly important. If ICE Make continues executing well, its flywheel could begin looking something like this. More industrial demand leads to more customer orders. More customer orders justify additional manufacturing capacity. Higher capacity utilization improves operating efficiency. Better efficiency supports healthier margins. Healthier margins generate stronger operating cash flow. Stronger cash flow reduces dependence on external borrowing. Financial flexibility allows management to invest in technology, service capability, and innovation. Better execution strengthens customer confidence. Satisfied customers place repeat orders. Repeat orders lower customer acquisition costs. Lower acquisition costs improve profitability even further. And suddenly, growth begins funding future growth. That is the point where a business transitions from expanding to compounding. The importance of operating leverage. Now let's discuss another concept institutions monitor closely. Operating leverage. Imagine opening a movie theater. Whether 20 people attend the show or 200, many of your costs remain unchanged. The building is already rented. The projector has already been purchased. The staff has already been hired. Once occupancy rises, a much larger portion of every additional ticket sold becomes profit. Factories behave similarly. Large manufacturing facilities often involve significant fixed costs. Initially, those costs weigh heavily on profitability. But as production volumes increase, those fixed costs are spread across many more products. Suddenly, profit begins growing faster than revenue. This is why many manufacturing companies experience periods where earnings accelerate dramatically after years of steady investment. The factory didn't suddenly become cheaper. It simply became busier. For ICE Make, this could become one of the most important developments to watch. If the recently created capacity begins operating at high utilization, operating leverage could gradually improve margins and returns on capital. But this outcome is not automatic. It depends entirely on execution. Innovation, the moat that keeps moving. Many investors assume that once a company develops a competitive advantage, it lasts forever. History teaches the opposite. Think about companies that once dominated cameras, mobile phones, or personal computers. Many lost their leadership not because they became lazy, but because the world changed faster than they did. Competitive advantages are not monuments. They are gardens. They require constant maintenance. In industrial businesses, innovation doesn't always mean revolutionary inventions. Sometimes it means improving energy efficiency, reducing maintenance costs, enhancing reliability, offering smarter monitoring systems, providing better after-sales support, helping customers lower their operating expenses. Every small improvement deepens customer relationships, and deeper relationships are often more valuable than lower prices. The hidden power of customer trust. Imagine you manage a pharmaceutical manufacturing plant. A refrigeration system failure could destroy medicines worth hundreds of crores. Would you choose the lowest priced supplier or the supplier with the strongest reputation for reliability? In mission-critical industries, customers often remember failures far longer than discounts. That is why trust itself becomes an economic asset. Unlike factories, trust cannot be purchased overnight. It must be earned project after project, year after year. For ICE Make, every successful installation is more than a completed order. It is a reference for future business. It is a signal to the next customer. It is an investment in reputation. And reputation, although invisible on the balance sheet, can become one of the strongest competitive advantages a company possesses. The risks that could slow the story. Every compelling business story deserves balance. Because investing is not about finding perfect companies. It is about understanding both opportunity and risk. For ICE Make, there are several questions that deserve continued attention. Will margins recover as new capacity matures? Can return on capital improve after this investment phase? Will operating cash flow strengthen consistently? Can debt remain comfortably manageable while expansion continues? Will management maintain disciplined capital allocation even if industry demand temporarily slows? None of these questions imply weakness. They simply recognize that every long-term investment thesis must continually be tested against reality. Markets reward companies that execute consistently. They punish companies that assume growth alone is enough. The institutional checklist. Imagine an experienced institutional investor reviewing ICE Make 5 years from today. The questions would probably sound something like this. Has revenue growth translated into stronger profitability? Have margins recovered? Is cash generation keeping pace with expansion? Are returns on capital improving? Has debt become easier to service because earnings have increased? Do customers continue returning with repeat business? Has management allocated capital wisely? Has the company's competitive position strengthened? Interestingly, none of these questions involve the daily share price. Because institutions understand something many retail investors eventually learn. Share prices fluctuate every day. Business quality changes much more slowly. But over long periods, the share price almost always follows business quality. A business at an interesting crossroads. When we step back and view ICE Make as a whole, we don't see a finished story. We see a business standing at an important intersection. Behind it lies a decade of impressive expansion. Ahead of it lies the far more difficult challenge, converting expansion into sustained wealth creation. The factories have been built. The industry opportunity remains attractive. Management has expressed confidence through investment. Now the next chapter depends on execution. Because history rarely remembers the companies that merely built capacity. It remembers the companies that transformed that capacity into durable competitive advantage. And perhaps that's the most fascinating part of this story. The biggest question is no longer, can ICE Make become a larger company? The more meaningful question is, can ICE Make become the kind of business that institutions are still happy to own 10 years from now? That answer won't be found in tomorrow's stock price. It will be written slowly, through every capital allocation decision, every customer relationship, every factory utilization improvement, and every rupee of cash the business generates. And that is exactly why the final chapter of this documentary isn't about predicting the future. It's about learning how to think like a long-term business owner rather than a short-term market participant. The real lesson was never about ICE Make. It was about learning how great businesses are discovered. Imagine it's 10 years from today. You open your old notebook. Inside, you find the notes you made while researching ICE Make. You smile. Not because the stock necessarily became a multi-bagger. Not because it doubled or tripled. But because you realize something far more valuable. This company quietly taught you how businesses create wealth. And once you understand that process, you begin seeing opportunities. The final reflection, the market will decide the price, but the business will decide the value. Let's return to the question we asked at the very beginning. Is ICE Make simply another listed company? Or is it a business quietly entering a completely different phase of its journey? After traveling through its industry, understanding its products, studying its management, analyzing its financial evolution, questioning its valuation, and observing how the market has gradually started recognizing it, the answer is no longer as simple as good company or bad company. The truth is far more interesting. ICE Make is a company standing at one of the most important stages in a business life cycle. It has already crossed the difficult stage where survival itself was uncertain. It has moved beyond being a niche engineering company known only to a handful of industry participants. It now stands at a point where the opportunity ahead appears larger than the business behind it. But this is also the stage where expectations begin rising, and expectations create responsibility. The difference between a story stock and a business stock. Every bull market creates story stocks. They promise extraordinary futures, huge opportunities, massive industries, revolutionary technologies. For a while, their share prices often move much faster than their businesses. Then reality eventually arrives. Some stories fade. Others mature into real businesses. IceMake doesn't need to become the biggest company in India to create wealth. It doesn't need to dominate every industrial segment. It doesn't need spectacular headlines every quarter. It simply needs to keep doing something much more difficult. Execute consistently. History shows that shareholder wealth is rarely created by dramatic announcements. It is created by thousands of disciplined operational decisions that most people never notice. Improving manufacturing efficiency. Winning one more customer. Reducing delivery time. Lowering operating costs. Developing better products. Retaining talented employees. Serving existing customers exceptionally well. Generating stronger cash flows. These aren't exciting newspaper headlines, but they are the building blocks of long-term compounding. The market is a voting machine before it becomes a weighing machine. Benjamin Graham once made an observation that remains timeless. In the short run, the market behaves like a voting machine. In the long run, it behaves like a weighing machine. Think about that for a moment. Every day, millions of investors vote. Some buy because of optimism. Some sell because of fear. Some react to headlines. Some chase momentum. Some panic during corrections. Daily prices therefore reflect emotions. But over many years, emotion slowly gives way to economics. Businesses that consistently create value eventually become difficult for the market to ignore.
Don't forget to like and subscribe.